All right, Scott Porter, you ready to go?
I am. Yeah, Mike, can you hear me?
Absolutely. Hearing you loud and clear. So terrific. Well, welcome to everybody, and welcome to this edition of the Interactive Dialogue, which is part of Dorsey and Whitney's series for a couple of different industries, one of which including the food and agribusiness industry. This is a different kind of format than many you have heard in the past. Often law firms tend to have 75 slides with a lot of detail and information on them, and then try and talk real fast through the internet to try and do their webinar. This is a different program where we really try to have a format that involves discussion on a topic, picking an expert like Scott Porter today for a illustration and real going into more depth on a particular topic. So Scott, very glad that you could join us today. For those who are sitting next to someone who's saying they can't hear anything, then nudge them and remind them that to listen to the audio portion of the webinar, they should log in with the information that I just circled. So my name is Mike Droke. I'm a partner in the food, beverages, and agribusiness industry group within Dorsey and Whitney. Dorsey, of course, a 19-office law firm with offices around the world, and now many more than that, as many of us sheltering in place, or today in Washington State, where I reside, we're quote-unquote staying at home is the order that we're under. So here today with Scott Porter, and Scott I've had the privilege of working with directly with clients. He's an exceptional professional and true expert in the area of merger and acquisition in the food and agribusiness industry. Scott, could you give a brief summary of your background?
Yeah, thanks, Mike. Happy to. So Scott Porter, I'm a Senior Vice President at Cascadia Capital. Cascadia Capital, for those who don't know, is a middle market investment bank across a wide variety of sectors. We have 4 offices in Los Angeles, Minneapolis, New York, and then Seattle, where we're headquartered. I co-lead our firm's food, beverage, and agribusiness practice. I primarily focus my time more on upstream transactions and companies. We work primarily with private family-held business owners to do 3 things. The first is help raise capital, both debt and equity capital. Part of this is balance sheet restructuring. The second thing we do is M&A advisory, so both sell-side mergers and acquisitions and buy-side. And then lastly, we've partnered with a few large wealthy family offices to make direct investments in the Northwest as well. So we do those 3 things. I spend most of my time on the agribusiness side. For us, that really means 3 things. It's inputs, so suppliers to large growers and producers. We work quite a bit and quite extensively with vertically integrated growers, packers, shippers. And then it's the primary processors, so think food manufacturing, food processing, ingredients as well. So that's generally our practice, Mike.
Great. And you, Scott, mentioned upstream. Can you describe what you mean by that?
Yeah, so as we think about the food and ag supply chain, we categorize it into really 3 categories: upstream, midstream, downstream. So I think of upstream as production ag, the growers and producers, think farmers, and the inputs and ecosystems serving those farmers. We think of midstream, where we spend quite a bit of time as food processing, food manufacturing, ingredients, and then we think of downstream as consumer branded products, restaurants, retail, which we also have practices focusing on here at Cascadia as well.
And so those practices, I take it, are kind of independent or interdependent with, but separate from the food and agribusiness side?
That's correct.
Got it. And then you also used the term, just for the people listening in, family offices. Can you talk about what that means?
Yeah, happy to. So we view the world of M&A counterparties across a number of different buckets. I'll talk of 3 today primarily. So there are strategic corporate acquirers. Think of large corporations, industry participants that look to acquire companies in the sector. Second would be private equity firms. So these are financial institutions. And then the third bucket is really family office and other institutional firms. Family office generally are large families that have traditionally owned companies. They've often had successful exits or liquidity events, and they're looking to reinvest that wealth across a variety of platforms. So one of the ways they are looking to reinvest that wealth is in the private markets, reinvesting it into private family-owned companies. What's unique about family office capital is generally they are very flexible, where private equity may have a fund life cycle, so they may hold capital for 5 to 7 years, but then need to sell that business and generate a return for their limited partners and their investors in that fund. Family office, they are more about capital preservation than they are capital appreciation. They don't like paying taxes, so they enjoy taking capital and wealth that they've built, reinvesting it into companies over a long-term period of time and over a long time horizon.
Terrific. Well, thank you. It's really helpful to kind of get some of the nomenclature down so that as you're talking through it, people will understand those three elements. And I really appreciated in particular that you described not only what they were, but also some of the unique features of different types of people who might be wanting to invest in the market. So we've got 10 themes we're going to talk about today. So we're going to go through them at somewhat a high level, but I do commend folks to talk to Scott directly on any of these topics. It seems almost, to me, fascinating that, Scott, you and I think, talked about doing this webinar first in January before there was this, really thing in the United States called the coronavirus. So we're of course going to be talking about the impact of COVID-19 and the coronavirus on international trade and some other factors in the tensions that are existing in the food and agribusiness market. But then, as you know, remembering Monsters, Inc., right? For every door that closes, another one opens. And so opportunities exist as well. And I'm really looking forward to hearing about that. And then how the M&A markets have responded, and then we'll come back to some predictions in regards to coronavirus as a cap off at the end. So can you talk about, we've got some graphs here, which I thought were really super fascinating. And I know that we could literally spend an hour on this slide alone. But can you talk first to, what the impacts are on food and agribusiness of COVID-19 and the like?
Yeah, happy to. So starting with COVID-19, I know, Mike, we'll spend some time at the end. So I'll really touch on maybe two quick topics now and how we're seeing it impact specifically the food and ag sectors. I think the two topics to touch on right now is the theme of this too shall pass. I won't today try and make a prediction of when. It's, of course, a very dynamic situation, very complex situation, and really changing every day. But what we're hearing from investors, particularly focused on food and ag, is the sentiment that this too shall pass. This is, I would characterize as somewhat different from what we heard in the Great Recession, which was this would be an extended period of a potential cyclical downturn, and I think investors shied away from making investments. What we're hearing today is this too shall pass theme. So that's the first one, and the second theme that I think is really important here is.
Can I ask you a question on that before we go to the second theme? I've been hearing in the media just kind of generally a discussion of the difference between a supply side driven recession and a demand side driven recession or whatever economic event. And is that kind of what you're describing, that this is more of a supply side? We've got people who can be laid off for a period of time, but the demand is still expected to be there, in particular in food and agribusiness?
That's right, yeah. And I think the theme that I will continue to go back to is the theme of putting it simplistically, everybody needs to eat. And I think we've seen it play out meaningfully with a number of our clients. As an example, we're working with a company that's in the frozen fruit industry. What they've seen over the last 3 weeks is a very large increase in spike in demand as consumers are not eating as much at restaurants. They're increasingly going to retailers stocking up on food, and so we're actually, for many segments or subsegments of food and ag, seeing an immediate spike throughout this area. So I think it's both driven by supply and demand. The supply side, we believe, will be somewhat impacted depending on where your supply chain is located. We are seeing supply chains being impacted, particularly if you have ties to your supply chain in China or parts of Europe. But generally, what we're seeing within food and ag, and again, going back to that theme that everybody needs to eat, is continued demand throughout the COVID-19 situation.
You know, it's an interesting anecdote, Scott, that I literally personally am on the phone every hour with a company that is just within minutes of the call been subject to a shelter-in-place, stay-at-home, or other restriction. I think we're up to 50% of the United States workforce now is under some kind of a restriction. And in each of them, there is a specific exclusion for the food supply chain or people supplying to the food supply chain because it's deemed in the national interest as literally a national security asset of the country to maintain a strong, vibrant food supply chain and to those suppliers who are working for the food supply chain. So to your point, it not only to make sure that people are fed, but also to make sure there's food on the shelves for just, public good and the like. So we're going to talk more about that throughout. But you said you had a second observation as well. What was the second observation?
Yeah, I think that second observation is not all impact of COVID-19 is created equal. And I would maybe, Mike, draw your attention to that top left chart. What this chart looks at is since February 18, the stock price changes across the S&P, and what you'll see is there's been roughly. Oh, go ahead. This one, right? I'm circling. Yeah, that's exactly right. Yep. And what you'll see is the yellow chart first across the S&P 500. There's been roughly a 30%. Now this isn't updated through yesterday, which we saw a big jump, but a roughly 30% decline in enterprise value multiples in the industry. What we've seen conversely within large public food and ag companies is only a 13% decline. So a meaningful difference. And the reason for that is the public markets are putting less weight or seeing less of an impact of COVID-19 within the food and ag sector for the reasons that we mentioned earlier. I think what COVID-19 has done for the food and ag sector is really validate a lot of the themes and macro trends that investors have liked, that being that food and ag generally is counter-cyclical or a little more insulated from recessions and downturns. And you're seeing that play out in the public markets with this data and this chart here, but we're also seeing it, especially in the M&A markets, play out similarly.
Now, that really kind of goes directly to the second chart on this page, correct?
Yeah, that's exactly right. That's exactly right. So I think just spending a minute, Mike, on what we're seeing in the M&A markets in light of COVID-19, our processes and across Cascadia's platform, we have roughly 40 to 45 transactions going on right now. On our food and ag team, we have roughly 10 transactions that are active in market right now. There are really two themes that we're seeing, or I'd classify each of these transactions into two buckets. Bucket A are companies that are directly impacted by COVID-19. So think, again, restaurants. Restaurants have seen a dramatic decline in consumers going to those restaurants. Think manufacturing companies that have an international supply chain where that has maybe been strained. Companies in that bucket, we're seeing these processes put on hold. Investors are saying, we like the company, we like the industry, but given everything that's going on with COVID-19, we're putting pencils down, we're putting the transaction on hold, and we're in a wait pattern until we see how things play out. Then there's bucket B, and I would put the majority of our food and ag transactions in this bucket. which is less impacted by COVID-19 and even in certain cases positively impacted. What investors are saying is we have a continued interest. We're open for business. We will continue to invest time, money, energy, and effort into this process, but we're seeing those processes get elongated and drawn out, primarily because investors are not going to make an investment without being able to meet the management team in person, see the assets in person, sit across the boardroom table face-to-face with the key stakeholders and shareholders. And with the inability to do that today, these processes are getting extended. And so generally, go ahead, Mike.
I was going to say, it's fascinating to me. For those cooks listening in, you'll know the metaphor. If you've ever cooked vegetables, for example, and then put them into an ice shock bath, to just stop the cooking immediately. And you can always then put it back in boiling water and finish off the cooking later on. And that feels a little bit like what's happening with COVID at the moment, that things have been put into a shock bath, just frozen for the moment. Not yet, but, let's wait, for just a little bit. I had coincidentally some travel on, I think it was March 9th. It seems like a million years ago now, but I remember walking through the airport, going down to the Bay Area and driving in San Jose with no traffic in the middle of the day, which was just completely a surreal experience. Then for those logging in from other parts of the country, we in the West Coast had been hit very early on, and so some major companies instituted an immediate work from home situation, which you feel at the same time as you hear about. So it sounds like you're seeing that play out. If people can't go to walk the plant, then they're not going to buy the facility because they need to walk through to make sure, that they understand the asset that they're buying and the like.
That's exactly right. And I think even for that second category or bucket where investors continue to be interested, we will see those processes and those dynamics being impacted by COVID-19, particularly these large public companies, large corporate acquirers. We're seeing them right now in the interim become more internal facing rather than spending and utilizing their resources and people's time on M&A acquisitions and events. They're becoming internal facing and focusing operationally. I think also with the hit that they've had to their market cap in the public markets, now is not as good of a time for them to look to make acquisitions. Not saying that is not happening now. It certainly is, but it is a dynamic that in the interim is impacting large corporate acquirers. The other thing we're seeing is in the lending community, lenders, in our opinion, from what we're seeing, are scrambling. They're getting a bit tighter. They're pulling back, and I think as lenders pull back during the COVID-19, it will impact acquirers' ability to maybe stretch on price and get deals done where there's a debt component. And then lastly, I think even though investors will continue to be very interested, especially private equity and institutional investors, what we've been hearing from them is they've really been looking in an environment where valuations have been higher than ever before. They're really looking for any excuse for some time to return to more of a normalized valuation environment. And I think we will see some investors in particular try and use this as an excuse for valuations to return to some old level of normal.
Which is, of course, exactly the time you need experts like yourself and others at Cascadia to help you increase the potential value of your business. So a shameless but appropriate plug. So
thank you.
So this is all happening on top of other issues that are happening within the food and agribusiness industry that really affect merger and acquisition activity uniquely to that industry. So can you talk about the first kind of mega tension of supply chain consolidation?
Yeah, happy to. I completely agree on it's a very dynamic time for business owners, not just with COVID-19, but I think that is a tension on top of other tensions that have been mounting over the past few years. I'll name a few and then get into the supply chain consolidation, but especially for growers and producers, the industry has become increasingly capital intensive. As you are well aware of, Mike, it's a very challenging labor market right now, particularly with all the nuances of immigration reform. In many parts of the country, Mother Nature has been taking its toll. In certain commodities and crops, there are different challenging supply-demand imbalances. I think on top of that, the strong U.S. dollar has made pricing here in the U.S. maybe less competitive on a global scale and further impacted trade imbalances. And then you have what we have on this slide here, which is supply chain consolidation. This consolidation, while it takes place gradually, we've seen consolidation ramp up in the supply chain over the last 10 years or so, especially. And we spoke earlier, Mike, about the supply chain of upstream, midstream, downstream. Here we're really looking at the suppliers to growers and producers, think crop inputs, like a Monsanto, like a Bayer, then the growers and producers themselves, and the retailers at the other end. What we're seeing right now is a squeeze on the growers and producers. There have been large multi-billion-dollar mergers on either end of the chain, which has produced fewer larger players that have the ability to have leverage on the smaller growers and producers, and it's squeezing the margin that growers and producers were many years ago getting out of that supply chain.
So that's when you have these arrows, that's emblematic of the squeeze that's being put on the grower producers in the middle, right?
That's exactly right. And my view and Cascadia's view is the growers and producers, in terms of their level of consolidation, they're, one way to put it is behind. Another way to put it is at the beginning or early stages of the consolidation process, which we see as accelerating now. Because of this squeeze, it's forcing consolidation at the grower-producer level to increase scale and increase the amount of leverage that they have, both with their suppliers and with their customers.
Interesting. So how long has this trend been going on?
So I think, as I've mentioned, at the supplier input level and at the retail level, this has been going on for the last 10 to 20 years. I think over the last 3 to 5 years in particular, we've really seen this trend begin to pick up at the grower and producer level.
You know, one of the aspects that I found fascinating in the grower-producer environment is the advent of private equity money coming in to buying the land, and also family office. So, can you talk a little bit about the implications of this for the people who want to buy?
Yeah, great question. So, my belief is that private equity capital, family office capital, and within that institutional bucket, there are also very large pension funds, there are endowment funds, asset management firms that are increasingly large pools of capital coming into the food and ag sector. They are only going to accelerate this consolidation process, especially as there's a need for this consolidation. And COVID-19 aside, the availability of private equity and institutional capital money within food and ag remains very strong, really for a few reasons. There's more capital than ever, more dry powder, as we call it, than ever before at the private equity level. Generally, and especially for private equity, they have a use it or lose it mentality, meaning they have capital committed and they have to put it to work. So this is creating a very favorable demand imbalance for those growers, producers, and business owners that are looking to sell. There's more capital out there than ever before. I think investors also.
Do you expect that to continue? I mean, and if so, how long?
We do expect it to continue. So generally, fund life cycles are 5 to 7 years. We've seen a lot of funds, particularly in the food and ag sector, raise more capital for new funds in the last couple of years. So I think for the foreseeable future, especially over the next 5 to 7 years, we think there will be a meaningful amount of capital that will be committed towards private family-held companies, and in particular food and ag business owners.
And is there anything about the food and agribusiness industry that makes it more attractive for that kind of investment capital than other types of industries?
Yeah, there definitely is. And I think investors from a broad macro perspective really buy into the thesis that the world population is growing. When you look, the forecast for world population to double by 2050 is there. I think, two, they look at the broad macro trend that the middle class globally continues to grow and accelerate, particularly in areas of China, Africa. What they've seen is as that middle class grows, so does their demand for high quality and safe food. And there's a general perception across globally that America produces very high quality and safe food. And so we're seeing in the export markets, with the exception of the last couple of years and some of the trade dynamics with China, we historically have seen very strong growth in the export markets, primarily because of this rising middle class and the globalization of food and ag and the supply chains as well. So I think investors buy into those broad macro trends. At the same time, the amount of arable land is staying the same and in some cases reducing. So I think it generally will produce very favorable pricing environments over the long term, call it 30, 40, 50 years. And investors like that. I think the second thing they really like is it's asset rich and asset heavy. So when they're investing in, say, a large vertically integrated food grower and producer that has a lot of orchards and farmland, they're buying something that they view as traditionally being a fairly safe asset that protects their downside and an asset that tends to appreciate over time. So I think investors really like this space for those two reasons, among others.
Yeah, it's interesting. It's much more tangible, of course, than many things that one could buy, software and the like. And you also have some natural barriers to entry for competitors that aren't that would be new entrants to the market, it seems.
Yeah, that's exactly right. I think the other thing that we're hearing from investors is valuation dynamics. So what we saw 5 years ago was within food and ag was a very strong rise and of interest in branded food companies. Branded food companies valuations tended at the time, because of some of their rapid growth, to be valued off of a revenue multiple versus maybe a multiple of cash flow or EBITDA. As those valuations got high, investors were looking for new ways to play the long-term macro trends that they really liked in the sector at valuations that were maybe a little bit lower. The other thing they saw when they were investing into branded food companies was consumers can be a little bit fickle when it comes to brands, and a brand may be hot one day and not the next. What they found is by moving a little bit downstream to maybe co-manufacturers, private label providers, is they can play some of these dynamics and broad macro themes across a variety of brands and a variety of different retailers and customers. So we've seen over time an increase in the level of interest in non-branded food, and even going down to the growers and producer level.
So the next tension that you reference is succession planning challenges, and I've definitely experienced this with my clients as well, where you have key leadership that are hitting retirement age. Can you talk to this one?
Yeah, and I can speak maybe a little bit personally on this one. My family, they are fourth generation farmers, And I've seen some of these dynamics play out. What we see particularly from growers and producers is the mentality of keep it in the family. And at the same time, the younger generations moving away from the farm and generally not coming back. And so we're seeing a meaningful challenge right now from a succession planning point of view, where many growers and producers and business owners feel a little bit stuck. They don't want what traditionally and historically has been in the family for multi-generations to leave the family, but at the same time, they're getting older and they don't have a next generation to pass it on to. And so we see these succession planning challenges as really a key driver, particularly in agribusiness, of consolidation going forward.
You know, I've been watching the correlation here, and it's really pretty direct that if you see a processor, for example, that's about, that's been led by an individual for 10 years or so, and that person's hitting retirement age, that seems to be the point at which, there's really a strategic decision that's made at the corporate level about what are we going to do. Is that a fair assessment?
It is, yeah, it is, and there are a lot of challenges that come with it, or maybe considerations that come along with it. As one example, even business owners who may be able to pass it along to the next generation, a lot of the strategic dialogue we're having with companies is how do you transition that ownership, especially in a way that provides some liquidity for the older generation that's maybe retiring. Generally, these balance sheets do not have a lot of cash sitting there on the balance sheet, and a buyout is not necessarily something that the company can take on. And so what we're seeing is either companies take on increased amount of debt to buy out older generations of shareholders, or seller notes. What it does, though, is it places an increased burden on the next generation coming in financially, especially as they are required to service an increasing amount of debt or shareholder payments, which puts them at a competitive disadvantage relative to maybe some of their peers who can take those cash flows and reinvest it in the business as opposed to it leaving the business. So it definitely is a significant challenge that we're seeing from a lot of business owners today.
Of course, no surprise that leads to the next kind of mega tension that's been existing in the agriculture industry for a while. And, this slide here really illustrates over an extended time period, really from 1970 to the present, the extent of debt in the agriculture industry. Is this unique to agriculture compared to other industries, or can you kind of give a comparative assessment there?
Yeah, I do think it is unique to agriculture relative to other industries. Certainly, debt is common in all industries, and certain industries may take on more debt than others. We found this to be particularly true within agribusiness for a few reasons. I go back to the keep it in the family mentality. So generally, business owners are more equity adverse. They do not want to bring in outside equity holders, and so they have looked to finance buyouts with debt. I think that's one. And then two is one of the side effects of being so asset rich, which is a positive, as we discussed earlier, is there are a lot of assets to leverage. And lenders, I find, generally look at lending one of two ways, or maybe a combination of the two. One is lending based on cash flow, so a debt to EBITDA perspective. The other is lending based on assets and asset value, so a debt to asset value. Particularly within ag, we've seen lenders historically being willing to lend on a debt to asset value. And so we've seen growers and producers take these assets, the value of the assets that has been appreciating over time, and leveraging them with debt that may not necessarily align with the cash flow that those assets are generating. And so what it's done is allowed them to put more debt on the balance sheets than they otherwise would have been able to if in another industry. And we're seeing this happen. I think the best quote is the one that's on this slide from the U.S. Secretary of Agriculture, farmers being at a level of debt really not seen since the 1980s agricultural crash. We do think that there are tensions mounting, and we're seeing a lot of overly capitalized balance sheets that are creating, that are requiring business owners to do something. And what that something is looks a lot of different ways, but it may be consolidation, it may be bringing on equity capital, or it may be choosing to not reinvest in the business quite in a way they have historically to pay down some of this debt.
You know, you made a comment as we were preparing that a lot of M&A is because of terribly capitalized balance sheets, and your comment was so direct, I knew I had to ask you about it today. What did you mean by that?
Yeah, great question. So today, I would say some of Cascadia's, for our food and ag practice, some of our best referral sources are lenders. Lenders are getting, I think, increasingly worried about the amount of debt. They look at this chart and many others, and they're rethinking their portfolios and their allocation. So we get calls from lenders often saying, our client needs additional debt or additional capital. We're not able to. Can you help them think through what maybe their capital alternatives are? These are generally companies that are already in special assets or going through workout that need capital and are essentially having lenders say that they're tapped out. So when we look at what their options are, it's again, try and raise equity capital or sell. And there are other options, but those are the two prominent options that we see business owners choosing, which in those cases are really being driven by debt and the inability to get more capital that they need to finance the business going forward.
Is this a particular problem for different types of people within the industry?
It is, yeah. So we see this being less of an issue midstream in particular. So the food manufacturers, the food processors that are maybe less asset driven, particularly on the farmland side. Where we see it really is at the grower producer level and those vertically integrated producers that have a lot of farmland that they have historically been able to lever up with debt.
And why would that be the case?
I think it goes back to lenders being willing to loan on a loan to value basis, and going back to the trends of the growers getting squeezed. So when you take financing on a value of assets relative to maybe what the cash flow is generating, it can create an imbalance in terms of the company's ability to repay debt from a principal and interest perspective.
And why would it be different in that way?
I think lenders have looked and get very comfortable with their downside risk and protection. If you're a company that have little assets, what's the secondary source of repayment? They really have to rely on cash flow. Conversely, if you're asset rich, you have a lot of high value assets that historically has appreciated over time. I think lenders can get a little more comfortable with putting more debt on a business because their secondary source of repayment is very strong should their borrower not be able to pay out of cash flow.
Great. So if you could, Scott, if you could advance to the next slide.
Yeah.
Terrific. So here you talk about, kind of pivoting here from the challenges to the opportunities, and why, what are the macro trends that are going on out there that create new opportunities for agribusiness?
Yeah, so I spoke to it a little bit earlier or touched on it very briefly, but just to quickly touch on it again, the rising middle class throughout the world demanding high quality food is a really important macro driver of what we're seeing over time. The growing world population and at the same time limited arable land. So arable land per person has dropped 39% in North America and 29% worldwide since 1960. These broad macro trends are very positive, even though there are maybe some near-term tensions. We have a thesis at Cascadia that those tensions will be worked out, and over time, these strong macro trends will come into play. I think the other thing that oh, go ahead.
What causes that theory? Can you describe that briefly?
Yeah. So I think we continue to see, in light of the tensions, strong demand internationally in the export markets. It's been skewed downwards a little bit because of the trade war that we've had with China. But generally speaking, we've seen, especially in certain subsectors, really strong international demand for U.S. food and U.S. products. We think that will continue, and as some of these other tensions that have been mounting wane, such as COVID-19, we think that there's a lot of opportunity for food and ag producers going forward and over the long term.
Could you move to the next slide?
Yeah, happy to.
This one I thought was interesting, in part because you have a barbell. What is a barbell industry?
Yeah, so our belief is, in the midst of tensions and consolidation, there's a lot of opportunity for growers and producers who are forward-thinking and have the ability to capitalize on companies that are going through and experiencing some of these headwinds right now. And what we tend to see in industries that are consolidating is it produces a barbell, where on one end of the barbell, and you can see this on the bottom hand side of the graph, you have few large-scale players. These are players that really compete on their size. They have strong operating leverage. That operating leverage produces higher margins. It produces more pricing power, and they really compete on the vast scale. We believe that within food and ag, the big are getting bigger because of all this consolidation, and we'll have a strong opportunity to continue to gain scale as this consolidation continues. Then on the left hand of the...
Do you have a timeline for that?
It's ongoing. The timeline, I think, is subsector dependent. So to give you an example, we'll look at the fruit industry as an example. The banana industry today is really dominated by 4 large players. Those 4 large players own 60 to 70% of the market. There are certain industries, so I would say that has already happened. There are certain industries that are in the midst of that consolidation now, and we think that will happen in the next 12 to 24 months. I'll use the tree fruit industry as an example. Apples, cherries, and pear providers. They are going through a large consolidation right now. We think that consolidation will take place over the next 12 to 24 months, where there will be maybe 4 to 6 really large providers. And then there are other subsectors that have not gone through that consolidation that are probably 5 to maybe 7 or 8 years behind. But certainly within the next 8 years, we think there will be meaningful consolidation across a lot of subsectors as well. If, though, not every company can become large scale, has the capital to do it, has the desire to do it, and that leads to the producers on the left-hand side of the barbell, who compete by being differentiated. They really dominate a niche, and it may be being really competitive in a certain variety that is proprietary to them. It may be dominating organics really well, having an incredibly strong management team that runs the business very efficiently. But for whatever reason, they're very niche and differentiated in the market. For those players that are in between, that are that do not have large scale or that are not materially differentiated, those are the ones that we view as being at risk for consolidation, and the ones that likely over time will be forced to either move to one side of the barbell or be consolidated by one of those acquirers.
Got it. And you're taking or finding, I guess, also that there is a consolidation amongst the investors. Is that a fair statement as well?
Yeah, I think it's almost the reverse of that. So where there's consolidation happening at the grower-producer level, there's actually more investors within food and ag today than ever before. And this is just a sample that we have on slide 11. But if you look in the 1990s, there were really, call it 5 to 10 large and prominent investors within food and ag. Today, and you can see on the right hand of the chart, there's 50 to 100 plus very prominent investors within the food and ag sector. So we've seen a rise of institutional capital having an interest in the food and ag markets, and that's accelerated some of this consolidation and created a very favorable supply-demand imbalance in the M&A markets and driving up valuations along the way.
You know, one of the things that struck me in this slide was the incredible diversity of the type of investors and players that you're seeing.
Yeah, that's exactly right. And there's a lot of diversity in the market, and much more diversity than I think we tend to see in other markets outside of food and ag. In particular, I've mentioned private equity, but we've seen a meaningful rise of family office capital, as we've discussed, but also institution funds going direct. So traditionally, institutional investors like pension funds, endowment funds, have chosen to make investments into private equity firms as a limited partner, and then have those private equity firms invest on their behalf. They pay the general partner, the private equity firm, a fee. What we've seen lately is many of these institutional investors begin to go direct in the M&A markets and make direct investments. So using a few examples, Ontario Teachers Pension Fund, a Canadian pension fund, fairly recently made a very large investment into a company called Droke Fruit, which is a apple, cherry, and pear producer with thousands and thousands of acres of orchards, a very large packing plant, and a sales desk. We're seeing many institutional funds like Ontario Teachers, like Harvard Endowment, as an example, make actually direct investments into the food and ag landscape. It's creating more opportunity and more optionality for business owners who are looking to transition their business, and again, increasing valuation as well.
Just fascinating to see this all play out across the U.S. really, and internationally as well. All right, you have a slide here about how the M&A markets are responding, not just by the way of the number of entrants, which perhaps doesn't surprise you that it would increase valuations as there's greater competition for the same asset. But can you talk to this slide and first, I guess, why farmland is circled, and second, if you anticipate any changes in the reaction to COVID?
Yeah, definitely. So this really ties to the slide prior, the rise of institutional investors. So I think one of the big reasons is why have there been so many new entrants of institutional investors into food and ag? And I think slide 13 is one of the main answers to why. And we circled U.S. farmland investments. What investors have found is on a risk-adjusted return basis, and this is a chart taken from TIAA-CREF that looks at the annualized volatility of these investments along with the annualized return. So being up and to the left, actually being safer, better return investments. So U.S. farmland today, and that really translates to vertically integrated food and ag producers is viewed as a relatively less volatile and potentially high return asset class. And as these, in a world where there's a strong search for return, farmland and agriculture businesses have become a large asset class that these investors are choosing to direct capital to as a result of that.
When we first started planning this program in January, the idea of quote unquote volatility was one thing, and boy, have we experienced volatility in the last 21 days, to say the least.
Yeah.
What are the implications of that, positively or negatively, that you foresee in the agriculture merger and acquisition market? Just the fact that
as a result of COVID,
shock
or?
to this. No, the shock to the stock market, and does that make the fixed asset of agriculture more valuable, potentially less valuable? What do you think?
Good question. So its impact on the market will be nuanced. I think it'll impact it to the positive and negative. It's a little bit of a double-edged sword. So I look at it two ways. I think in the immediate period, there's an argument to be made that there's less buying power. We are seeing investors become more internal focused on their current portfolio and managing their current portfolio. We're seeing strategics become more inward facing operationally and making sure that they manage through this time. So in the immediate period, yes, it could have a slight impact. But I think in the long term, what we're seeing through this shock is some of the stability of the everybody needs to eat type of factor. And I think it will only validate investors' thesis that food and ag is somewhat countercyclical and a great asset class to allocate large pools of capital, especially when you look at U.S. equities or international equities as being quite volatile during these times. I think investors will look to allocate capital towards investments that are perceived to be perhaps less volatile.
And so put another way, as the next slide indicates, you anticipate a flight to quality. Is that the fair statement?
Yeah, that's exactly right. And we see this in any type of environment where there's tensions mounting and opportunities that arise. What it really means is the M&A markets will be strong, but we'll experience a flight to quality. And we've already begun to experience that the last 2 or 3 years. And you can see it on the top right chart, the decline in food and ag M&A from 2017. We've essentially had 10 to 12 straight quarters of decline. And what that's reflective of, we have viewed it as a little bit of a leading indicator of not necessarily a recession, but an investor perception that a recession could be looming. What we heard from investors during the Great Recession and the last downturn was the companies that they thought they overpaid for. So they were very competitive processes. They were industry-leading companies. They thought they paid too much in order to win. Those were the ones that did really well throughout the downturn and the investments that performed well for them. Conversely, the companies, I'll class it broadly as Class B companies that maybe were not differentiated, were not necessarily leaders in the industry, maybe had some hair on them, but they thought they got a great deal on it. Those were the investments that performed quite poorly during the downturn. And so what we're seeing right now is investors become much pickier and more choosy about the investments that they're making, those quote-unquote Class B assets that may have historically had 5 or 6 bids. They may have been at a lower valuation relative to Class A counterparts, but they still had bids. Today are not transacting. Investors are more wary of making an investment in a Class B asset in light of a potential or looming downturn. And that's why you see valuations holding. We're hearing investors say we are willing to pay top dollar and high valuations for those Class A assets, but we're going to be less interested and more selective around those Class B assets. And that's kind of what we mean, Mike, by flight to quality.
And also what you mean by quality, that it's not evenly distributed across food and agribusiness.
That's exactly
instead,
right.
Yeah, people are wanting to invest in the quality assets within food and agribusiness, but not those that have some operational challenges or the like. Is that fair?
Yeah, very fair. And that Class A asset to us can mean a lot of things. They may have industry-leading scale. They may dominate a certain niche and be very differentiated and command higher margins or have a competitive moat because of that. They may have historically reinvested heavily into updating their assets, and they have better assets than anyone in the industry. They may have a strong growth trajectory relative to their counterparts. So it could be a variety of things, really strong management team that makes or qualifies a company as a Class A asset. It's not necessarily one thing, but often we find it reflected in the margin and financial performance, the revenue growth and opportunity, and having an industry-leading margin profile.
You know, often attributed to Winston Churchill is the quote, "Never waste a good crisis," or "Never let a good crisis go to waste." And it strikes me that we're now in one of those. As I indicated in the beginning, it's a little bit like ice baths for vegetables cooking. That one of the takeaways I'm getting from your comments here, Scott, is that if you feel like there's some hair or absence of quality in the asset that you're managing as a business person, then one thing you could do in regards to coronavirus is stop for a moment and think about how do we use this as an opportunity to kind of correct that.
That's exactly right. And especially for companies also thinking about an M&A event, what you do in the 3 to 5 years leading up to it can have meaningful valuation implications in terms of how you're perceived as being maybe a Class B asset with some hair on it or a Class A asset. So I think it's a really good point, Mike. There's a lot you can do to take advantage of some of the tensions in the market right now, but also there's a lot that can be done 3 to 5 years pre-liquidity event.
So what's your prediction after, the work from home, stay at home, shelter in place restrictions are removed and things get back to hopefully normal, although maybe a different type of normal?
Yeah, so I think we will see in the immediate term slower economic growth and weak economic activity in China. I think there will be increased unemployment and reduced buying power as a result, and potentially some supply chain disruptions. But as we've discussed, it will create opportunity, particularly for food and agribusiness participants. And in the mid to long term, we really view it as a timing factor. So the M&A markets will still continue to be active and get done. Those that do not get done in light of the COVID-19 crisis that we're in will be a timing factor, meaning there will be pent-up demand. When the market normalizes and returns, we believe that there will be a dramatic and fairly drastic influx of M&A activity because of that pent-up demand. And we saw this during the Great Recession. Not as many deals getting done in the midst of the recession itself, but that pent-up demand during that time leading to more activity as soon as the market's normalized. Now, we don't think that things with COVID-19 will last nearly as long as what we saw in the Great Recession, but we do think that there will be some pent-up demand and that the M&A markets will remain fairly strong during this time and especially after.
So I'm going to ask a question and then make a comment so you can think about your answer for a moment. My question is, You mentioned about a Class B asset with some hair on it. If you had 3 or 4, maybe 5 things that would constitute the hair that you typically see that folks listening in should really say, okay, we're going to pivot and focus on these 3, 4, 5 things, what would those things be? So before you answer that, or as you're thinking about your answer, just an explanation of the slide. At Dorsey and Whitney, we very early our first presentation on the legal implications, I think it was the first in the United States, was on March 4th on the coronavirus topic. And contemporaneously, we established a coronavirus resource center that's being constantly updated. Even the stimulus package that was announced this morning is being summarized, and we'll be on that momentarily. So we do encourage listeners to go to the dorsey.com/coronavirus website page. There's descriptions there, including audio playbacks of webinars like this one on topics ranging from employment law implications to how to handle force majeure clauses in your supply chain. One of the topics that we're getting called about on, again, an hourly basis is the extent to which you can stay open in stay-at-home kind of requirements. So with that, Scott, I asked the question about what are the top handful of things that somebody could do during this crisis to help kind of shave off some of that here and move yourself from a Class B to at least a Class B plus. What do you recommend?
Yeah. So as it relates to the crisis specifically, I think there are really three things that we're seeing from our clients. The first thing is examine your supply chain and manage risk through redundancy. As we've discussed, we do think that supply chains, if not already, will continue to be impacted. So having supply chain redundancy is critically important. Having volume and supply to retailers and customers when they want it and need it is, as many business owners know, critically important. So looking at and examining the supply chain and making sure there's that redundancy is important. I think the second thing is putting policies and procedures in place to plan for potential plant disruption. We're seeing our clients and companies do quite a few things in this time right now. Some are creating work groups or pods on the manufacturing floor or out in the orchards to create work silos and maybe limit interaction. Some along those lines are staggering work schedules. We've seen business owners begin to monitor temperature when employees come in as many as 2 to 3 times per day. Stressing communication for employees saying something at first sight of symptoms. We also see some companies increasing their medical infrastructure. And then the last thing I would suggest as it relates to COVID is stress testing the financial statements. So modeling downside budgeting scenarios on how an impact or slowdown may impact cash needs will be really important. Understanding how fluctuations in the supply chain with inventory or distribution can impact cash, and then really assessing the right capital structure for your business, taking advantage of maybe some line of credit capacity that you may have to really bolster the balance sheet to weather this COVID-19 are some of the things that we're really recommending to our clients right now.
Fantastic. Those folks that are listening in, we're going to be holding a webinar at Dorsey and Whitney on April 1st, I believe it is. You'll be receiving an invitation to it that will be addressing those very practical issues you were talking about, Scott, on how to handle plant disruptions. It's been, I will say, unique in my career that this experience, and in part because we've been invited through our clients dealing with the crisis into some of their basic business operational planning. How do we literally keep the doors open and the company operating or not in a way that is sensible? So we're going to be sharing some of those practical tips on upcoming webinar as well. So you'll be receiving and have received the reminder sheet to get your CLE credit and the like. Please submit your evaluation to Michelle Hubble. Her information's here. It's also on a link attached to the reminder email that was sent yesterday. So we encourage you to do that. And again, to Scott and the extended team at Cascadia Capital, thank you so much for exceptional information. And I do, for those listening in, really recommend contacting folks at their team and the other service providers that they work with. And as you're anticipating kind of how to deal with M&A transactional issues, in particular in light of our current coronavirus situation. So, Scott, any final word?
Mike, really appreciate the time this morning, and thanks for all your expertise as well.
All right, terrific. And with that, we'll end the webinar. Thank you.